Good morning, everybody. This is Fred Meissner with the weekly technical market conference call for the Fred Report for January 13th, 2011. Happy New Year to everybody, since I didn't get to wish everybody that last week because I forgot to start the recording on the call, for which I apologize. So we'll get right into it here. First of all, the stock market. We are seeing some improvement, but we still don't have an all-clear sign yet. There has been some breadth improvement yesterday. Yesterday was actually a pretty good day for breadth, but the momentum indicators on breadth, like the McClellan oscillator, for example, still look like the continuation or close to the end of a move rather than a new move starting. So we want to see a couple more days of very strong breadth and a move through 130 on the SPY. That would be inclined to give us a all-clear signal. I do want to say, guys, I think this is a bull market. If I were investing in stocks here, I would be comfortable buying here as long as they move back down to 1,200 on the S&P, or maybe a little lower, say 1170. Didn't bother me. In other words, the move back down to the December lows is about as low as I think we're going to go. I know there's some people out there that think we're going back down to 1040, 1050. I just don't see that here. So, if I'm a stock investor, I'm happy. If I'm a stock trader, though, I'm probably sitting on some cash here hoping to get a dip because I don't mind buying a little bit higher. So, let's see what happens. But we're coming into a holiday weekend. Generally, the market is sort of up into a holiday weekend. This weekend coming is Martin Luther King weekend. And so let's just see what happens. But, we're basically happy with the market, except for the fact that it looks like we could get a sharp drop here. Let's talk for a minute about sentiment. Sentiment is very mixed again now. The Investors Intelligence percent bears came in at 19, which is a pretty low number. But we have to mention the put-call numbers have actually been improving. And sentiment, remember, is a condition indicator for us. The fact that sentiment is really, really bullish doesn't mean the market has to go down, but what it does mean is if we do get a shock in the marketplace, that any sort of a drop could be a little bit sharper and nastier than everyone is thinking about. And let's go back and just check for a minute. The drop we had last February, where we dropped about 10% in 2 weeks, is the sort of thing we're talking about. The other sort of anecdotal thing on sentiment that I don't like is you're seeing things on MarketWatch and some of the websites like this is the year of the stock. Peter Eliades, who's a very nice man and a very good friend of mine, was bullish all last year, and now he's talking about a 25% up move by the first half of the year. That sort of thing just gives me a little bit of pause, and says that if we do get a correction, it could be a little bit sharper than everyone thinks it could be. In terms of the bond market here, we remain long-term bond bears, but the pattern short-term on bonds is such that we could get a nice move up in bonds into the 96 to 98 area, and we are trying to trade that move up, and it could end up being better than that. The accumulation model on bonds is one of the strongest looking accumulation models that I have, so I kind of want to try to trade this on the upside, and let's see what happens. Certainly, if you're a bond investor, if you're looking for a place to buy bonds for clients, this is one of the places where I would be going in and doing that. Probably 10-year maturities or so. And don't overlook the fact that the corporate bond index, the LQD that we follow, has pulled down the long-term support and is basically testing its long-term breakout, and looks to me like it could rally also. If I were buying bonds for clients, that's where I would be looking more than likely. So we're looking for 94.50 on bonds and then the 96, 97 area. As part of bonds, we're going to talk for a minute about financials because there's a huge amount of buzz on the financials. In order to do that, we're going to talk about the XLF, and we'll get into some financial stocks in our stock section of the call. But when you look at the XLF, realize that we are still below the April 2000 peak on the XLF. That peak was 17 area, and we are 16 area now. So with all this hoorah, we're still below where we were last April on the financials. And to put that into perspective, Staples, which is the defensive sector, it was 28 last April. It's 29 now. Technology was 61 last April. It's 66, 67 now. Energy was 58 last April on the XLE. It's 69 now. So you have to say that these financials of the XLF are still long-term underperformers, and that's why we have them rated as an underweight in our sector report. We're trying to do some long-term performance there. And they are still a nice heavy underweight, although they've had a bounce. And again, if financials rally in the first part of the year and then languish, that wouldn't be a big surprise to me. We'll just have to see how that shapes up. In terms of the commodity markets, we are still pretty bullish on commodities. The DVC has broken out above the 26 area, 27 area resistance at 2781. We caution folks that the commodity favorable seasonality is led by oil at this time, and oil's favorable seasonality has a tendency to end January, February. So energy may be seeing the end of a little bit of a run, and the accumulation model on the USO suggests that after this period of seasonality, we could see a correction in oil, or alternatively, just flat sort of consolidation in oil. We're long-term commodity bulls, but we think that move could really take effect in the second half of the year rather than the first half of the year. The reason we mention that on the USO is one of the best performing sectors into the end of the year has been the XLE, and our stocks like Chevron, for example, that we were recommending in the low 80s have gotten into the 90s and such, ExxonMobil. Don't let those profits go away if you're traders. You want to sort of snug your stops up on those and realize that we may see that Chevron pull back into the 85 area if we get a market correction. In terms of gold, gold is still one of our favorite long-term areas. Momentum-wise, it's sort of sluggish, but it looks like the GLD is holding 132 to 130 now, and I'm still maintaining my 17-month target of 152 on the GLD. And so that means that gold is probably cheap here. If your risk is 5 points and your reward, is 15 to 20 points, you kind of got to look at that as favorable and be accumulating gold. I don't think I'd be rushing into it, but I would want to hold on to it and look for it on dips. And with that, we'll start in on the basic stock section of the call.